Okay, so in discussing secondary indicators and applying secondary indicators, what most people do is just find three, four, five, six indicators and just apply to the charts and just take the trades based on what signals they give. Sometimes it can lead to confluent signals, sometimes it can be divergent signals, and that can leave a trader with mixed signals or mixed decisions in regards to whether they want to buy or sell. Yes, the idea is to apply a secondary indicator to only give extra confirmation from your primary analysis in the first place. And that's the correct way of applying an indicator. And the indicator you must apply should be different to, say, a second indicator that you also apply to your charts. They both can't be measuring the same thing or with a slight different calculation. It doesn't really give you additional information. Yes, you can apply two indicators, giving you the same amount of information. That's known as multi-collinearity, which generally means, okay, yep, if I get confluence from two of them, that gives me a higher probability setup. If I get confluence from one, I'll still take the setup, but it doesn't give me full confirmation, so therefore I'd go in and at a reduced risk. Yep. But when you apply three, four, five, all leading to the same amount of information or leading to the same measurement of that price move, doesn't really get you anywhere. Yep. So it's overkill. So just to give you an idea, what you should be looking. Let me just get rid of that. So what we're seeing over here, guys, what we're seeing over here is, let's assume price has moved as such. This is where price has moved. So a couple of things that we're measuring. So at the bottom here, we've got time, and sort of on the right hand side over here, we have price. Yep. So time over price is what's being measured, and in most cases you will see sort of a chart with sort of these lines going across like this. And what are we seeing overall? Okay, so yes, we've got price over time. So over time, what's taken place with the current price, how much demand or how much demand there is. But there is a lot more information in this. So the first is, yep, the direction. So the key is from this low up to that high, the direction it's had, it's this. Yep. So that's showing you that's a trendy market. It's moved higher and higher. It's carried on with the higher highs and higher lows. So this is showing you the momentum of the market. So what you need is one indicator that shows you or measures the momentum, how much momentum there is in the market. Yep. And then this. So this will be seen as your volume indicator. So you need a second indicator that measures volume. Yep. So yes, the volume indicator is going to tell you not just what buyers or sellers are doing, it's telling you the total amount of trades going through in the market. Naturally, if the price is going to continue to rise and also volume is continuing to rise, it shows you, yes, there is still more demand in this asset. Whereas if price continues to rise but the volume depreciates, that's showing you, well, there's not enough buyers in the market, or there's less buyers than previously, so there's maybe less demand going forward. It may show you an early and give you an early warning that there might be a potential top. Yep. So yep, volume is an important indicator. So your first indicator must be momentum. Your second indicator must be a volume indicator. Your third indicator must be something that measures volatility. So from this low up to this high, that is a volatile move. So that's your market range. Yep. So you need a third indicator, which is showing you volatility in the market. Yep. So you need a measure of momentum, volatility, and volume. Those three indicators is all you need for a secondary indicator analysis.